So let's get started right away. How to be a day trader with $1,000. This is this is futures day trading. It's better than stock day trading, in my opinion. I did stock day trading for many years, and this is where I ended up. There's just too many stocks out there, and to trade stocks, day trade stocks properly and effectively and profit with profits week after week, the easiest way to do it, the path of least resistance that I've seen people do, is to become really, really familiar with one stocks, maybe two, maybe three stocks, so you can learn their patterns and you can feel the stock. But this is better. I like trading futures better. So right now in this video, we're going to go over trading futures and how easy it is to get started. I use NinjaTrader because I began day trading back in 2007, 2008. So NinjaTrader was the best thing around. It was free, and it had a good connection. It was really flexible, and they upgraded from 7 to 8, and it's just beautiful. And I highly recommend NinjaTrader. It's free to download. I don't work for them. They don't sponsor me. Nothing like that. This is just a tool that I've used over the years, and I'm recommending over to you. I'm passing down this knowledge over to you. So the first thing here, we have a chart open. So if you want to learn charting with NinjaTrader, I'll either do a separate video, but if you can't wait for that video to be released, then go to NinjaTrader YouTube and you'll see right away. This is how I trade. Let's get started by learning one thing per video. Here we're going to learn Andrew's Pitchfork. Okay, so let's learn it right away, because this is a question I get all the time. I have another video on Andrew's Pitchfork, but I'm going to make this one a little more quick and in depth. So let's go here. Okay, so this is the previous day. Let's say today is September 23rd. So every morning I go here and I hit the open price. This is the open price. And I hit the high of the day and the low of the day. By the way, this is a random day that I picked. This is a random day. So I don't know what's going to happen. I don't know if it's going to work on the following day. See, yeah, the price level is the same over here. Okay, and the Andrew's Pitchfork is there. I drew it, and let's see what happens on September 25th. Okay, this is what I do every single morning when coming here. And here we go. This is the ES. It's the S&P mini contract. So here's Andrew's Pitchfork. I have three lines on my chart. I have the 200-day moving average, which works really, really well with the ES. The 50-day moving average, which works excellent with the ES. And I have the 13-day moving average, which is a 50-50. It's not very certain, but sometimes it works really well. Some people use the 10 or the 20 and the 50 and the 200-day moving average. But this is something I do every morning. I have different charts set up, and this is one of the main ones. So here it is. Here's Andrew's Pitchfork for today, and you would go long if this is the 100 line, this is the 50 line, this is the 0 line. You would go long if a price closes above the 0 or the 50 line. You would go short if it closes below, okay, below the 100 or the 50 or the 0 line. You would go short. So what happened here on this day? This was a random day. I'm going to pick another random day so you can see that I'm not making this up. It works really well with the ES. It doesn't work 100% of the time, but it works, I would say, just without doing any calculations, I would say it works about 70% of the time, from anywhere from 60 to 70% of the time, and that's all you need. So here we go. So enter here, because the candle closed. Okay, didn't went and take, don't do this. Don't do this. Wait for the candle to close and go on the next candle. So this candle closed here, go on the next candle. Boom. So here you lost. You lost a little bit of money here. So you lost 04, 03. So you lost maybe 1 point. You went from here, 04.25 to 03.25. You lost 1 point because you got out as soon as this candle closed. You got out. Then you got back in, boom, and you lost again. Okay, it's right about 70% of the time. It's not right all the time. Remember, there's no such system that's right 100% of the time. Okay, so here you went in here, 04.75, and you got out here. Okay, 04. So you lost 3 ticks here. So you lost here about $36, 36 bucks, or 45 with commission, something like that. Okay, then here we go. They took you in for this candle. This candle was humongous. Yeah, this candle didn't quite close on top. This candle was humongous here. There's no chance you're going to get in. There's no chance you're going to get into this candle here. This is just happening live, but you might get in here. Okay, you might get in. Don't recommend it. It's too overextended, and it may just touch the 50% line. So the strategy is, if you can enter here, somewhere down here, eventually it's going to touch the 50% line, and you only get out if a candle closes, okay, below here, and if a candle closes below here. I would not enter this trade here, because what are you going to make? You're going to make from 06.25 to 06.50. Maybe 06.70. You're not even going to make a full point here. So I wouldn't take this. It's too risky. I may go in here, right? When this closed over here, this would be another losing trade. A lot of losing trades today with this Andrews Pitchfork. But here is where it gets interesting, right? The 200-day moving average line is way more powerful than the Andrews Pitchfork. Way more powerful indicator. So this trumps everything. The 200-day moving average is probably one of the most powerful indicators for stocks, for anything that you will ever do. You have to listen to this line. You have to go by this line. This is God right here talking to you and saying, the God of trading, he's saying, no. It's like a rubber band, right? So here we go. Forget it. Once it goes to the 200-day moving average, forget this Andrews Pitchfork. Throw it away. It's no good. Now we're going to change, and we're going to go to the 200-day moving average line. And we're going to do the same thing. We're going to go long if it closes above, okay, here, 07. Okay, and we're going to go short. And we went long, we lost here, right? Because we went long here. I guess it opened here. Go open a little more lower. 07, and we lost 06. So we're down about 3 points today, okay? And it's 10:30 a.m. That's not cool. But look what happens. Look what happens right now. So this closed below the 50-day moving average line. Remember, this is this is heaven sending you signals right here. And now it's time to go short, okay? And here we go. So here we go from 06, okay, down to 04.50. Okay, that's 2.5. I would have taken this trade right away, and I would have probably closed the trade right here. Another one that I'm going to show you in a different video is the Fibonacci line. Now, it's not going to work because, it's not going to work from yesterday's trade, but I would have done it here. Okay, remember the 50, very important indicator, the 50-day moving average. Okay, so it's going to go from the 200 over to the 50. Okay, and it's boom. Okay, so we got, how much did we get here? We got from 06.75 to, we got out at the 50, 04.7, that's 2 points. So we're still down 1 point. So what do we do? Again, we see that this thing closed below. Keep an eye on volume as well. We see that this closed below the 50-day moving average. This candle right here closed below the 50-day moving average. And what do? okay, we're gonna get in. We're gonna get in on this trade. Also, the volume wasn't that high, right? So it's not really a trap, right? If you see volume just be like ridiculous, like I'm gonna show you a couple of bars later, be careful. Be really, really careful. Okay, so low volume, big candle right below the 50-day moving average line. We're gonna get in right here, right on this trade. Remember, we're still down 1 point, but we're gonna go low. Okay, the stop that we're gonna place, you need to place a stop immediately, right? The stop that we're gonna place is gonna be 05, right? So here, 02, maybe the 50% of this line, I would say, right here, somewhere here, 50% of this line. Only if a candle closes above the 50% level of this line will get out, but no more than that, because low volume here. So what happens here? We go short, and boom, 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 boom. I probably would have taken profits right here, 97. So from 01 to 97, now we're up 4 points. This is what a bear trap is going to look like. When you see this long line over here, when you see this long, not line, candle right here, when you see this really long candle here, and you see this ridiculous volume bar here, okay, I'm going to go over, I'm going to make separate videos for all of these traps that they set for you over here. But when you see this, I mean, just ridiculous amount of volume, long bar, this is bad news. This is what I call a bear trap, what a lot of people call a bear trap. Get out, okay? Get out right here, because most likely it's going to reverse. Another sign that this is reversing is, here's the 50% of this bar, okay? So first you had the volume telling you, look out. This may not be what it looks like. Then you have this violating the 50%, the 50% metric of this candlestick right here. So that's another sign that, wait a minute, this is not good. So time to get out. You have two indicators telling you to get out. And if you still weren't convinced, this should have convinced you here. I mean, it's a big, by now, you would have lost a lot, but you would have still been, up. So, and this is how we do it. So what my sign here, when this is going back up, is that it's going to touch either the 50 or the 200, and I would probably take profit at the 50 line. So really important lines here are the 200-day moving average, and the 50 and the 13. Okay, and this is how we trade with the Andrews Pitchfork.